Gilbert, I'm going to ask you if you'd be kind enough to provide an overview of what you see in the M&A market currently, and maybe focusing on some of the more significant transactions, the deals that have occurred, and what they portend for the future.
Thank you. So as a banker, I work a lot with numbers, so I'm going to start with some statistics, if that's okay. So year to date through August of this year, there have been 60 transactions announced in the investment management arena, and that's down about 25% from last year. And what's driving that? It's really uncertainty in the market. Valuations have not come up, and asset levels of asset managers continue to be lower relative to their peaks in 2020 and 2021. Do we see that changing? Of course, it will change, but so far this year, it hasn't been as good of a year as last year. But when you look at the mix of deals, of those 60 deals, about 75% of those involve alternative managers, in particular private markets managers. And that involves private credit, private equity, venture, real estate, and infrastructure managers. And the 25% is involving traditional or long-only and diversified managers that provide products in the mutual fund, ETF, or institutional fund arena. There is, of course, activity in the mutual fund and ETF space, and there has been a lot of consolidation in that area, and we'll talk about those too. But really what's driving why private market is really interesting for strategic buyers, and it's because their underlying investors are looking for exposure to illiquid strategies that provide significant levels of return, even with locked-in capital. And so that's what's driving a lot of the M&A activity in that space, led by GP staking firms and also by strategic firms. But as it relates to sort of the mutual fund and ETF arena, we have done a lot of work at Oppenheimer advising on the sell side mandates as well as on the buy side. I would say on the ETF side, given what the SEC has done in 2019, where they've made issuers much easier for them to be able to launch ETF products and have removed the time-intensive process of getting an exemptive relief, a lot of ETF sponsors and issuers have come to market. That being said, we all know that the business itself, or the AUM, is dominated by the top three, and they account for about 75% of total assets under management today. The top 20 issuers account for about 97% of assets in the ETF space. And there's probably around 70% of issuers with less than 5 products in ETFs that are in the market, and another 70% that have less than 1 billion of assets under management. So what does that mean in terms of potential M&A activity in the sector? I think the larger ones are getting larger, but they don't have to acquire to get there. They'll just grow organically. The ones in the middle, those that are ranked in the number 10 to number 35 will be acquirers of smaller platforms, and that will be part of the trend going forward. Earlier this year, we worked with Amplify ETF, which is a 4 billion AUM thematic and fixed income ETF sponsor, to acquire the assets of ETFMG. ETFMG ran about 4 billion of assets themselves, and has agreed to an asset purchase whereby Amplify ETF will be doubling their assets in a asset purchase deal. So we see more of that happening across the middle market space within ETFs. The other trend that we're going to see and continue to see is that there will be new entrants into the market. Those new entrants will consist of firms that are strong in the mutual fund arena, but are nowhere just yet in terms of being in ETFs. And the better use of capital perhaps is for them to acquire as opposed to organically launching and growing their ETF businesses. So that's kind of one. Second, as you all know, asset management is a global business, and there will be players both in the US and non-US that want exposure to managers across the globe, and there will be continued activity of new entrants into the market coming from non-US players. We saw that last year, for example, in 2022, Amplify also sold a minority stake in their business to Samsung Asset Management, which is a Korean asset management business. And from that transaction, they jointly developed products and also enhanced their distribution across not only the US but also in Korea. Most recently, ARK Invest announced acquiring a majority interest in a firm called RICE ETF to get into the European market. both in terms of ETFs and usage in Europe. So those are the sort of some of the deals that have been driving the ETF industry to date. In terms of mutual funds, again, some statistics there. Total mutual fund assets globally is about 22 trillion, and it's grown at a rather small rate on a compounded annual growth rate, 3% over the past 5 years. And if you look at the top 100 mutual fund complexes, only 15 had inflows over the past 12 months. 85 had net outflows. So it's been a challenge for many mutual fund players in terms of growing organically. Relative to the ETF space, where total assets are only 7 trillion, and the CAGR of those assets under management over the past 5 years has been about 15%. And so, you'd see mutual funds really trying to get into the ETF space organically or acquiring, or for those that are, not in mutual funds forever would likely want to sell. We've seen that with recent examples, a large transaction with Franklin Resources buying Putnam Investments for about $1.3 billion, announced in May of this year, likely to close in the next couple of months. That was structured as both a share and cash deal. 70% of the transaction was paid up front, 30% in an earnout subject to revenue hurdles, and a majority of the consideration was in stock of Franklin Resources. Why was that the case? It formed a strategic partnership between Great West, which owned Putnam, and Franklin Resources, so that going forward, Great West would allocate $25 billion of their capital from the balance sheet into fixed income and alternative credit strategies at Franklin Resources. But at the same time, from Franklin, why did they do it? First, they're going to be inheriting $130 billion of assets, a lot of it in mutual funds. There's an ability to consolidate, funds that have similar investment strategies, and perhaps retain the team that has a better performing track record for those strategies. At the same time, Franklin was going to get into and expand its presence in insurance asset management, as well as in defined contribution and 401k assets. And ultimately was priced at 2.3 times revenue, about 8.25 times EBITDA post synergy. So it's a pretty decent multiple to pay for a business like that. But it did enhance Franklin Resources' AUM in the mutual fund space in the same way that they did when they acquired Legg Mason back in 2018. We see that that type of deal has been happening for the past 5 years. We were involved in the sale of the mutual fund business of Foresters up in Canada. They have a U.S. mutual fund business called First Investors that was sold to Macquarie, Delaware, in a consolidation transaction, purely asset purchase. Only the assets were taken, none of the people. It was priced accretively for the buyer as well. Following that, Macquarie Delaware bought Waddell & Reed, a public company, and also consolidated the mutual funds of Waddell. AIG funds sold their mutual fund complex to Touchstone, which is owned by Western and Southern. And you've got Victory buying USAA's mutual fund business. So, it's a lot of, activity in the space, and what we see, and we can talk about it a bit more later, is that large global financial institutions, insurance companies, and even the public markets who see that it's better to use the capital from divesting out of these businesses to then invest them in higher ROE or higher returning investment opportunities is the right way to go, as opposed to compete with the larger firms that are continuing to get scale in mutual funds.
Gilbert, thank you very much.